everyone. We're going to be covering receivables in this chapter. So accounts receivable, note receivable. We'll be spending our primary amount of time on accounts receivable. If you think about how we're handling these chapters really through the rest of the time we're together, you start off, the last chapter was about cash, now we're moving on to receivables, then we're dealing with inventory, and we're moving down to liabilities and so on. So we're hitting really the big, we're working our way down the balance sheet is what we're doing. We're hitting the big items. Okay, so this chapter is about receivables and, primarily accounts receivable. Accounts receivable is credit you grant to customers, right? It's just accounts receivable is just what arises in your regular trade or business. You do some work for somebody, or you sell them something and you send them a bill, and that is an account receivable. You're just waiting for the money to be due to come to you. You're expecting to be paid usually in about 30 to 60 days. There's no interest most of the time. I'd be kind of strict if there were interest. It'd be unusual. Normally it's just, a bill, and you wait to get paid. Notes receivable, though, is a little bit more formal. Notes receivable usually requires some signatures. There's more than 60 days. There's some interest that accrues on it. Notes receivable can be short-term or long-term, and it all depends on what the terms of the agreement are. If it's less than a year, it's going to be a short-term note receivable. If it's more than a year, long-term note receivable. Okay. Separation of duties. We talked about this a lot in the last chapter with internal controls, but you want to keep the collections of the receivables separate from the accounting of the receivables, right? You want to keep those two pieces apart, so you prevent things like receivables, from disappearing, the cash disappearing that's supposed to be paid, right? And we talked about that a little bit in the lapping scheme. So you want to keep those separate. And one of the easiest ways to do that is to have people pay you through electronic funds transfer, right? Because then it goes straight into your bank account, which is a complete third party. So the actual cash collections part of it is held separate from the person actually doing the journal entries. Right? Customers send the payment to the bank. There you go. And the bank sends you documentation, the accountant, and then the accountant updates the records. So the idea is that has been, being able to send money to the bank directly through electronic fund transfers has been a really good thing for internal controls that way. Managing receivables, you have credit checks, right, out there. You don't want to be selling anything significant to customers who may or may not pay you, right? There's two types of credit checks you could do for individuals. There's, three major agencies: Experian, TransUnion, and Equifax. And here's my little 2 cents here. I would strongly recommend that you go into these sites and you do a credit freeze. It's not a big deal. You just have to verify you are who you are with information only you would have. And the idea is that nothing can be opened in your name. No credit, no cars, no anything can be opened in your name. Now, it freezes it, but you can just go back in and, if you wanted to do a credit card or you want to buy a car or something, you can go in and you can lift it. You can lift it for like 30 days. You can lift it for 60 days. But then it goes right back on. Because one of the best things I ever heard from a security session that I went to was that you have to just assume your social security number is out there, assume your personal information is out there, and act accordingly. And what would you do? One of those things would be you'd freeze your credit. So I know that my credit's frozen, my husband's credit's frozen, and we needed something. I think I was getting a new credit card because I wanted to change things up, and I just lifted them, and they went right back on. So it makes me feel a little secure. That's my little 2 cents of information. But anyway, so that's for individuals. Corporations, Dun & Bradstreet often does the ratings for people, right? You have how well is the company rated, how are their bonds rated, how is their stock rated, and so on. Well, what if somebody doesn't pay you, right? At the end of the day, people aren't always going to pay, and it's really kind of what this chapter is about. I mean, you don't have to remember the steps here, but I'm just trying to give you an idea of the progression, right? So maybe you send them a notice and you say, hey, you didn't pay us yet. And maybe you start assessing interest and a penalty. Maybe you pick up the phone and you say, hey, why haven't you paid yet? Is there a problem that I need to know about? Then if it's a customer, right, that you routinely send things to, you stop sending them things, right? You don't want to ruin the relationship. It could be a bill that that didn't get paid. It could be many things, right? But you don't want to stop orders until you're sure they're not going to pay you. Then you start reporting to the credit agencies, right? You start dinging their credit. Right. Then you could sell it to a collection agency. So companies do that a lot. If they don't collect on their receivable, what they'll do is they'll sell it to a collection agency for like pennies on the dollar. So let's say I owed somebody $100 and I wasn't paying them. That company could then turn around and sell my $100 receivable to a collection agency for maybe like $5. And then the collection agency, that's what they do. They hammer you until you pay. It's their job. That's what their whole thing is in business for. And maybe they get the whole $100, and if they do, they win, right? You could take somebody to court, and then maybe you just give up. Depends on what it's worth to you. Okay, so not like I said, not like there's steps on the follow-up. I just want to kind of give you an idea of how that progression worked. Okay, uncollectible accounts. Like I said, that's pretty much what this chapter is about. Receivables come from your regular trade or business. You've been doing journal entries of those. You just buy, sell, buy things. You owe money. That's payable. But then you have receivable if you sell something, right? So that regular accounts payable, accounts receivable thing is just normal or day-to-day business operations. But inevitably, like I said, people aren't going to pay you. It's going to happen, whether it's because somebody went bankrupt or maybe they just hated your product or whatever the reason might be, you're going to have to deal with uncollectible accounts. So let's look at how we journalize that. Let's say you have a credit sale for somebody. So, right, you got accounts receivable, $1,000, and sales revenue, $1,000. Right, that's just your regular, you sold something to somebody. But what if it isn't collectible? So the way we have to do is we'll have to reduce the receivables on the financial statements, and we'll have to record something called bad debt expense. Okay, you might also see uncollectible accounts expense, but it doesn't quite roll off the tongue. So I'll be sticking primarily with bad debts expense, but it's the same thing. So when do you recognize this bad debt expense? Let's say you have the sale in 2015, and some point in 2016 you decide that's it, you give up. There may not be any particular reason why you give up. It just might be that enough time has passed and you've sent them lots of notices and they just haven't paid. Or maybe you found that they filed for bankruptcy. There's no specific tried and true reason or specific calculation you do. It's not like at 6 months we write off receivables. No, it's going to be your judgment as the accountant as to when you write off a receivable. So on 12/31, we have to estimate bad debt expense. Now, how do we estimate bad debt expense? We do it based on what we know and what we've seen in our business over time. Some are going to have higher bad debt expense than others. Depends on the industry you're in. Okay. So let's talk about, here we go. Here's uncollected, the definition. Accounts receivable deemed by the company to be uncollectible. Like I said, there's no specific reason. It's not like any of these reasons could be why you write somebody off. The easiest one, the most straightforward, is the direct write-off method. Unfortunately, it's not GAAP approved. Right? We can't do things that aren't GAAP approved. Well, we can. GAAP allows us to do it if the receivable balances are so small that they're just not material. Meaning, like, you don't have receivables. There's plenty of businesses that don't have receivables because they deal primarily in cash. So if that's the case and the receivable balance is so small, you don't have to do the GAAP approved method. You can use the direct write-off method. The journal entry for the direct write-off method, easy. Debit bad debt expense, so you record the expense and you reduce the receivable. Very straightforward. Let's look at an example. Sean Valley is an attorney, blah, blah, a direct write-off method. Accounts receivables totaled $19,000. She earned $22,000, collected $15,000. There's a lot of information here. She also wrote off uncollectible receivables of $1,100 on May 31st. That's the piece we're focusing on. So the direct write-off method, we're going to record the bad debt expense. We've decided $1,100 is uncollectible. So debit bad debt expense and reduce the receivables by $1,100. That's it. Direct write-off. We said this person or these people are not going to pay us. We're taking them off. We're getting rid of that receivable. Okay. The second question has a little bit more, and we get to use T counts, which I love. What is Valley's balance of accounts receivable at May 31st? Well, there's a lot going on here, right? So let's throw a T count in. So we started off with $19,000 at the beginning of the month. There's our beginning balance. We earned another $22,000 of accounts receivable, so we're going to put that in there. I mean, these are things that happened during the month, right? And they would have all had journal entries, but we're keeping it simple here with the T count, just tracking the totals. And we collected $15,000, so there's our $15,000. And then we wrote off $1,100, so we have to reduce it by $1,100 as well. So if they ask me what the balance was at the end of the month, let's subtotal it, $24,900. And that's your answer. Okay, so here is, I was going to let you try it, but not yet. Here's the same problem at Shawnee Valley. What if they pay? What if you wrote somebody off that $1,100, you assumed they were not going to pay you, and then they did, right? So the steps we would take is we would reverse the original write-off, like, guess we shouldn't have written them off, let's reverse that entry. And then we're going to record the money as received. Okay, so this is the $1,100 from the previous problem. Let's record this. Step 1, reverse the original entry. So instead of a debit bad debt expense, credit accounts receivable, we're going to flip it. All right, because it's kind of like they're canceling each other out then. We're going to debit accounts receivable, credit bad debt expense. So we flip it. Right, reversing it. Second part, if you're not sure what I'm saying, go back to that previous entry. You'll see I just a reverse of the two. The second part, now we just, as if the entry never happened, as if that write-off didn't happen. So now we're just going to collect cash. We've got a debit to cash and a credit to the receivable. Because it's as if we never wrote anything off and somebody just sent us a check in the mail, so we've got a debit to cash and we reduce the receivables by that amount. Okay. So, okay, we're going to pause before we get to get allowance method. I'll see you in the next video.